Yo guys, what's up? It is Monday, June 30th. I got dressed up for you. No, no, actually, I went out to my favorite place, Home Depot. Yeah. Man, I go there so often. I just was curious. Do I own stock in Home Depot? I check my portfolio. I don't, but I should. But anyway, it's not at a level valuation wise that would get me involved, but if it comes down a little bit, I'll buy it. Yeah, I had to pick up some leveling sand because I'm putting in some pavers. I built like an outdoor shower. I just putting down some more paver stones. Maybe I should do like a DIY network. Do it yourself. Anyway, guys, how about the bond yields coming down, 422 on the 10-year? So the bond market's in play, and it goes back to what I was citing, which was this whole thing that Trump is going to nominate a new guy early, and that is going to shift expectations, market expectations toward whoever is the new guy. It's going to shift expectations towards that person's outlook. And Trump has said publicly that he's not going to take anybody unless they're willing to cut interest rates. And so you've got a big short position in the 10-year Treasury on the part of speculative funds. Last week, the Commitment of Traders report showed that they started covering some of that short position pretty aggressively, actually. So there's a lot of firepower there. There's a lot of potential buying power there in that short position. So I would just take any dip at this point and build a long 10-year position, because I think once the Fed starts cutting rates, and we don't know if that's going to be this month. There's a meeting on July 30th. There is some dissent within the Fed. I've been talking about that as well. I think Powell, the criticism that he is receiving, public criticism from Trump, I think that's starting to tarnish his image a little bit. There are members of Congress now saying that he lied to Congress on this supposedly there was I don't know if it was a $2.5 billion renovation of the Fed building in Washington, D.C., and he wasn't honest about that. But I said the guy is dishonest. I've been saying that for months, that the guy is dishonest. So I don't know why anyone should be surprised at that. The guy is a dishonest guy when he comes out and he says, the Fed is data dependent, and it's absolutely not been following the data whatsoever. He keeps projecting inflation from tariffs. Maybe that's going to happen. I don't know. But so far, we haven't seen any of that. So market continues to go up. I think a lot of this right now is also a FOMO rally, fear of missing out. As I said, I think I mentioned on Friday that I've started to lighten up some of my positions in stocks. I just put limit orders at higher levels, and as the market drifts up, I'm taking some profits. I just want to raise some cash, so I'll have cash to deploy when we get a correction. Everything looks good to me in terms of the fiscal flows. There's only one thing that I could point at right now, and that would be net government transfers as a percentage of GDP. All right, that hit a high of 4.2% just before the April tax drain, and now it's at 3.7%. We have not made a new high in net government transfers as a percentage of the GDP, or as as everybody else calls it, the deficit as a percentage of GDP. I don't use the term deficit because it's misleading. It's unnecessarily has a negative connotation. It might be the deficit of the sovereign, of the government, of the issuer of the currency, but it's a surplus. It's an addition to the balances of us, the non-government. By the way, there's still like 173 billion that needs to be recovered from the April and June tax drain. Okay, so you could see very clearly when they say, you know, we got to work 3-4 months to pay our taxes. It's right there in the numbers. It's right there in the numbers. I mean, that's not a lie. That's not an exaggeration. We're still working to get that money back that was drained out since April 15th. It's way too much. It's ridiculous. Now, Senate is about to pass their version of the reconciliation bill, the BBB, the big beautiful bill. I get a kick out of the headlines. Of course, you know, I don't expect the headlines to be very enlightened in terms of MMT or understanding how our monetary system works. So it's, you know, there are always these hyperbolic, scary headlines. The debt, it's going to add 3 trillion to the debt and blah, 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 this kind of stuff. I mean, the correct way to say that is it's going to add 3 trillion to non-government financial balances, you know, over whatever period. Maybe that's a 10-year period or something like that. Because that's what it equates to. It's going to add, if those numbers are correct, and I'm a little bit skeptical, I'll talk about that in a second. If it's going to add 3 trillion to the debt, what that means is it's going to add 3 trillion to the financial balances of us, the non-government. So this is why I always say to you guys, like, and this is not an expression that I made up, obviously, but knowledge is power. If you understand this stuff, like I do, you laugh at the headline like that, and B, you say, oh, that's great. We're going to have a wonderful monetary environment now for the extended future. I mean, I'm not against adding 3 trillion to the balances, because in one way or another, we all benefit from that. I mean, maybe you don't get the chunk of that directly or whatever, but in terms of how it supports economic activity, that supports jobs, that supports wages, that supports investment, capital formation, et cetera, et cetera. So I got no problem with that. And frankly, I like it when it's portrayed as something dire, because again, I have the knowledge, I understand, and it's to me, it's like, you know what? Set the bowling pins up, I'm going to knock them down. It's going to be an easy strike for me and for people who understand. A lot of you don't understand, and you don't care to understand. You're very happy. I did a video about this last week. You're very happy within your bubble of whatever, anger, resentment, judgment, victimhood, that kind of stuff. Instead of getting educated, instead of becoming informed, instead of knowing what to do, you'd rather just play the victim and like, oh, government spending, blah, 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 inflation, blah, 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 devaluation of the currency. Let me talk about that devaluation of the currency, because that's another big headline that's out. So the dollar's down like 10% or something like that since January, maybe a little bit more, I don't know. And now it's kind of, I guess you could say in the last couple of weeks, it's I don't know if you could call it an acceleration in the drop, but it's become a little bit more pronounced. How do I know? I was long the dollar. I just got out with a small loss, but I'm going to keep trying to buy it. But and really, Forex is the only market that I'm an active trader. Okay, I don't. Everything else for me is stocks, and it's accumulation of stocks. That's wealth building. All right. But like, here's the thing, and I talked about this, like they're selling the dollar on the outlook that interest rates are going to come down, that the Fed is going to cut interest rates. And I've been all through this. Number one, like the ECB has cut rates 10 times, and the euro is very strong right now. Countries that have raised interest rates dramatically, like Turkey and Argentina, have seen a total collapse in their currency, okay? This is the way it works. I mean, I did a thing last week about how if you have a theory, it has to be consistent in all applications. You can't say that cutting interest rates is bullish for the euro, but somehow it's bearish for the dollar. I mean, either it's bullish for a currency or it's bearish for a currency. It can't be, you can't use it in two different situations, the same application in two different situations, with different outcomes. That just shows that your theory is wrong. One side of that theory is wrong. And it's very obvious to me that what's happening to the dollar right now, see, here's what I think is going to happen. The market's anticipating this rate cut or rate cuts by the Fed. And so once again, these monetarist zombies, they're selling the dollar, and it's working right now. It's working right now. By the way, I would also add that probably back in March, April, when the trade war, the tariff war was in full force, and when we saw firms and U.S. consumers really stock up on foreign goods prior to the implementation of the tariffs, everybody was front running the tariffs, and we had this massive increase, this historic increase in the trade deficit. That was, that was a fundamental development, economic fundamental, which justified a weaker dollar. So that was correct. But that's been, that very, very extreme widening of the trade deficit has largely been corrected. All right, we just got the new trade, the advanced report for May, and that was down to it got a little bit worse in May, but it was around 90-something billion for May. I think it was up, I don't remember what it was up in that peak moment. It was maybe 120. It was huge. But this argument cutting rates, that's going to cause a dollar crash, but yet cutting rates for the euro when the ECB cuts rates, somehow that's bullish. It just doesn't fly. So I'm waiting for the rate cut now. I got a small long dollar position, no big deal, but I'm waiting for the rate cut to finally happen. And this to me is exactly the same as the rate increases, all the forecasts of recession and market collapse and all these horrible things that were supposed to happen to the economy when the Fed started raising rates. And I was telling you guys back then that rate hikes are fiscal adjustments. They're going to add to government transfers to the economy via that interest channel. And that's exactly what happened. And the markets ran to new all-time highs, and they kept going to new all-time highs. And I said that was we were going to reach an inflection point where the transfers were going to offset completely the negative aspect of, discounted cash flow. And by the way, I think that whole formula that financial people use for discounted future cash flow, I just think that's a flawed, that formula is bad because it does not incorporate fiscal flows at all. It's net present value. It does not incorporate fiscal flows at all. And what it's based on, from what I can tell, it's based on the loanable funds theory. This is a discarded theory saying that there's a finite quantity of money available. And so when the rate is increased, it reduces the availability of, that's not the case. And as a matter of fact, it's opposite. When the rate is increased, and since the government is a net payer of interest, when the rate is increased, It literally transfers more money to the economy. We saw that. So the formula, which was created by financial types, I don't know when they came up with this formula, probably a long, long time ago. It's in all finance and accounting textbooks and stuff like that. It's just wrong. It's based on an inapplicable theory, an inapplicable system. We don't operate in that system anymore. Where there's we're not under a gold standard. We're not under a fixed exchange rate regime. We just don't operate in that system. So the theory's wrong, man. Just like they're wrong on selling the dollar. So what happens is you get the stampede effect, the herd effect, because they all think the same way. We know this, that they all think the same way. So they're like, oh, they sell the dollar. They don't look outside of their small bubble here, like what's going on with the Fed and the United States. They don't even connect the dots that, oh yeah, the ECB cut rates 10 times and the euro is flying, or Argentina raised the interest rate to 100-something% and the currency is crashing. The same thing with Turkey. Gee, how come it's the exact opposite of what? No, they don't even pay any attention to that. They don't pay any attention to that. And I'm not talking about your normal guy walking around in the street. I don't expect that the normal person walking around in the street would understand anything like this, or would even have any interest in understanding anything like this. The guy, turns on the TV or whatever, or goes on X or wherever he gets his information, and whatever they say on there, to that person, that must be the truth. But we know that's all garbage. Okay, I'm talking about these people. I know a lot of these people. These high-level people on Wall Street. One guy, who I don't know, but I saw one guy today saying there's good rate cuts and there's bad rate cuts. I mean, what the hell is that? I mean, some guy, he's working for JP Morgan, had some funny name, like it seemed like some kind of Slavic name or something like that, like Muchik, Schmachik or something, I don't know. And like now, seriously, these guys are getting paid a lot of money, folks. They go with suits, they go to their jobs on Wall Street, they're getting paid a lot of money. Everybody, they go to conferences, they talk, people listen. There's good rate cuts and there's good guys, bad guys now. Good rate cuts, bad rate cuts. I mean, this is ridiculous. They don't understand the most basic concepts of the things they're talking about. There's no such thing. You don't have to. What are they gonna do next? Are they gonna put like a gender on it? There's a female rate cut and a male rate cut. I mean, what comes next? The idiocy has gotten to the point, folks, where it's just like, I'm sorry, but you gotta laugh. You gotta laugh. The next thing is gonna be like a gender rate cut. I'm telling you right now, or a gender rate hike. There's a male rate hike and there's a female rate hike. Or how about this? There's a male rate hike and there's a female rate cut. That's what it's going to come to, because this is just careening down the path of massive idiocy. And everybody else is walking around, oh yeah, it must be like that, yeah, because they're saying it on CNBC. It must be like that. Joe Kernan is nodding his head. And the other woman, I don't even know her name, was it probably a Karen or something, right? It must be right. You got to wake up, man, folks. You got to wake up. A lot of people want to stay in the dark. Like I said, man, like it's a free country. You could do what you want. If you want to stay in the dark, if you don't want understanding, if you don't want knowledge, if you want to watch Joe Kernan, rate cut. If you want to watch Muchik Fachik or listen to Muchik Fachik of JP Morgan, whatever the fuck his name is, that we got a good rate cut and a bad rate cut. What is it like when they cut rates and it's a bad rate cut? Powell's going to wear a black hat, then he's going to wear a white hat when it's a good rate cut. Or this guy, Muchik Fachik, is going to come on TV with a black hat and then he's going to, when it's a bad rate cut? Because according to him, this rate cut's good. I mean, come on, folks, I'm asking you. Just stop for a second and think about it. Do you understand how ridiculous this is? Do you understand? Do you see how ridiculous this is? I mean, I can't even put it to words how stupid this is. But this is what passes for, serious information. Anyway, that's it for today, folks. Please like and subscribe. Don't forget, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial to MMT Trader. 30 days for free. If you don't want to learn, if you don't want to get some knowledge, if you want to stay in the dark, if you want to listen to Joe Kernan, that's up to you. But my thing is out there. Bye.